Let's look at this example. The company has received its bank statement dated May 31st, and here's some important information contained in that bank statement. First of all, just the previous statement balance, $1,500, certain information on deposits that were processed by the bank, checks that were written. Those are, may have their use, but for the most part, they're not relevant to our reconciliation. But the next items are, there's a service charge that the bank charges. We probably have not taken that into, we haven't recorded that yet. We typically might wait for the statement to come to actually make that entry. Check returned NSF and not sufficient funds. That means that a customer has written us a check for $100. We've deposited that check, and yet when it got through the system and got to their bank says, no, they don't have the money. It comes back to our bank. And so we had deposited that money, and now our bank is taking that $100 out of it. So there's where the NSF check comes in. A note collected by the bank. Sometimes companies will use their bank so that, for convenience, so that, for instance, some customers in this case who owed money, in fact, to the company, can make their payment to the bank. So here's a note collected by the bank of $300, and the balance as of the statement date, May 31st, is $5,675. Now you got some information at the bottom of this page. According to checkbook receipts, deposits of $29,000 were made during May. Okay, that's what our records show. Outstanding checks at May 31st total $600. That's important to us. Deposits in transit at May 31st total $6,000. So those outstanding checks, of course, are not reflected in the $21,000 of checks written shown above in the bank statement, nor are the deposits in transit reflected in those $25,000 of deposits. The balance in the company checkbook at that date was $10,900, so that would come, of course, from the company's records. Well, let's look at the bank reconciliation. The first part is going to show how we get from the balance that the bank reports at the end of May 31st, to how we get to the corrected balance. Notice we here add the deposits in transit of $6,000. In other words, it's just a matter of maybe a day or two before the bank receives until the bank recognizes these $6,000 of deposits in transit. But also outstanding checks. We've written checks of $600 that the bank hasn't yet processed yet. So again, in a matter of time, those checks will make their way through the system, and that money will be taken out of our bank account. So in just a matter of time, instead of $5,675 in our bank account, we'll have $11,075. Or probably a better way to say that is that were the bank to know about and process the deposits in transit and these outstanding checks, the balance that they show would be $11,075. We call that the corrected balance, even though it's not the result of errors. Those are just timing differences. Well, let's turn our attention now to the lower part of the bank reconciliation, and that is the portion that concerns the company's records. The balance per the company's checking account, on the statement date, is $10,900. Now, we've got these items that we've already mentioned. Notes collected by the bank, that is a $300 increase to our cash account. Service charges, $25 deducted, and this customer NSF check for $100. Well, those represent three reconciling items. Once we take those into consideration, we find that the corrected balance is $11,075. So it matches the corrected balance of the bank, so we've been able to adequately reconcile the bank's records to the company records. So we're in good shape there. But notice something, we've got one more thing to do, and that is because these reconciling items on this second part of the reconciliation, really because they represent items that are of adjustment to the company's cash account, we actually have to make a journal entry related to that. And so here's just in summary, there's that's lower portion of the bank reconciliation from the previous slide. And now we see the entry that would be required due to these corrections. Overall, notice that they have a net effect of increasing cash by $175. We charge the bank fees, so it's an expense account. We could call it service charges, whatever, but it's $25 that represents an expense. Notice the customer who gave us a check for $100 that turned out to be no good, we charge that, or we add that to that account's receivable. In other words, we set up a receivable from that for that customer's account. They owe us that $100. And we credit notes receivable for the $300 representing the collection of that note. Now notice here this entry will always affect cash. In other words, the result of this reconciliation was to, let's say, uncover or reveal certain changes that need to be made to the company's cash account to get things right as of the statement date. And so notice any reconciling items up in that first portion, that is going back to look at the bank, those are simply timing differences that in fact don't result in any entries for the company. By the way, if you saw it sometimes happens, it's rare these days, but let's say the bank made a mistake of some kind. If so, what you would do is you would call the bank and start that process of getting them to make that correction. But it would not involve any entry on your part. In fact, if the bank, if the error is in the bank's hands. On the other hand, these items that are reconciling items on the lower portion of the bank reconciliation, these all represent changes that should be made to the company's cash account and therefore would require an adjusting entry.